Good afternoon, everyone, and welcome to Treasury Strategies Higher Ed specific webinar, where we're going to talk about getting more value from your account analyses. Thank you for joining us this afternoon. I'm Kathy Gregg, and I'm joined here in Chicago by Tony Carfang. We are both managing directors at Treasury Strategies, which is a division of Novantas. For those of you who might not know us, for 3 decades, more than 3 decades actually, Treasury Strategies has been providing advisory services to all segments of corporate treasury. And now we're also offering some tools to support Treasury Strategies, one of which we're going to talk about today. Everyone who signed up for the webinar today will receive a copy of our presentation deck as well as a link to the recording of the session once we're through. And also, you can ask questions during the webinar. There's a button at the center bottom of your screen. If you click that and type in a question, we'll try and answer your question live during the seminar, or we'll answer them after, depending on how much time we have and how many questions we have. Let me just quickly go over the agenda here for this afternoon. We're going to we have a lot of higher ed users in our new account analysis standardization product called NDepth. And as a result of that, we've been accumulating higher ed specific information about banking service usage and fees and ECRs. And we want to share some of those things with you. And we think you'll find those very interesting. Then we want to spend a little time talking about how NDepth can actually help you save time and money, how it can help you focus on opportunities to improve your banking structure and your service usage at your banks. And then finally, stick around to the end of this session because we have a very special offer for you that we think you're going to be very excited about. So with that, I'll hand it over to Tony.
Well, thank you, Kathy. As Kathy mentioned, we have a lot of higher ed users of our NDepth service, and we've been able to capture a lot of data and put that together in a way that we think you'll find very interesting today, both in terms of looking at what we're seeing industry-wide and comparing yourselves against the industry, as well as some insights that we're gaining as we see how the industry pricing and earnings credit rate shapes up and stacks up against other companies. So to look at the overall wallet, the overall spend, we see from the higher ed companies in our database a fairly even distribution of services across bank treasury management products. We see 21% of the spend going to Lockbox, 22% to ACH, 23% to information, 15% to disbursement services, 10% to wire. So it looks like, within higher ed, unlike some other industries, you're using a variety of payment mechanisms to conduct your business and manage your operations. One of the things that we do in NDepth is we take all those pesky little line items on your account analyses and roll them up into what we call product families. These are higher level services that make it much easier to compare service usage across banks who use different names for different services, and this kind of makes sure we look at apples to apples. Now, as we drill down into some specific products, here are some fascinating curves that we're going to show today. This was on Lockbox, but to explain the general format here, the horizontal axis across the bottom are the volumes. In this case, volumes of lockboxes, 1,000, 10,000, 100,000 items per month. And the vertical axis on the left is the all-in unit price of the service. So one of the fascinating things that jump right at you is the degree to which these curves slope downward and to the right, which show that these are really scale-driven services. And recognizing that they're scale-driven services, you may have an opportunity to do some things within your own operation to take advantage of that, perhaps consolidating services from among several banks into a smaller group in order to increase your volumes and lower your cost. Now, on this particular chart, we're looking at Lockbox, which is 21% of higher ed total spend, according to the many higher ed organizations in our database. The blue line on this chart represents the price curve for higher ed. The red line is the median for the entire market, for all of the companies who are Treasury Strategies clients in the NDepth database. And the great news here is that the blue line is lower than the red line. That means higher ed is paying less for Lockbox than at every volume level than the average company in our database. Now, before we pat ourselves on the back, though, let's try to understand why this might be the case. And clearly, it could be your negotiating skills as an industry. It may be that higher educational institutions are marquee names the banks like to have on their client list and maybe discounting, or it may reflect that you're buying a more plain vanilla package of services rather than some of the higher order and more expensive services that many of our other clients are buying, and perhaps that's something that you ought to investigate. And you might be asking yourself, why am I not paying $1.29 an item and only paying 82 cents? Is there something I'm missing? If we look at these, the average at the volume level of 10,000, that blue line intersects at 82 cents. So higher educational institutions are paying on average 82 cents per item for a 10,000 item a month Lockbox. The rest of the market is paying 50% higher at $1.29. So again, it may be useful to investigate that variance. The other fascinating thing, we talked about scale, that 82 cents an item median price for higher ed drops to 27 cents as the volume goes up to 100,000. Now, many organizations might be setting up multiple lockboxes for a whole host of different reasons, but as you do that, and you're fragmenting your business, keep in mind you're moving to the left on the cost curve, which is sharply upward sloping. So that may be worth a second look. Now, let's move on to electronic payments and ACH, which represents 22% of the total spend in higher ed. So that clearly says that a lot of your transaction volume is going through EDI or ACH, most likely ACH. And again, the blue line is lower, and that's a good thing. That, again, as we said earlier, that could be the ability to negotiate. That could be the relationship value of having your name on the bank customer list. But it can also be that there are value-added services that other companies are availing themselves of that, as an industry, higher ed is not. At the 10,000 ACH item a month level, higher ed is paying 24 cents an item versus 38-cent market price per item. That's a huge favorable variance. Scale dynamics not quite as sharp as in Lockbox, but as the volume increases tenfold, the price gets cut in half from 24 cents down to 12 cents. Now, the flip side of the equation are the earnings credit rates that banks are paying you for the balances that you leave on deposit. And here, let's just take a couple seconds to look carefully at this chart. The horizontal axis are the balances that you have on deposit. The vertical axis are the earnings credit rate that you're receiving. And unlike the cost curves that you saw that are downward sloping to the right, these are upward sloping and to the right, which means the more balances you have on deposit at a specific institution, the higher the earnings credit rate. Now, the blue lines here, let me explain. These represent percentile bands. The top blue line is the 75th percentile of all of the data in our database for higher ed. The bottom blue line is the 25th percentile. The red line is the median, which is not necessarily the midpoint in there, as you can see. So 50% of all the data from higher ed in our database, the ECRs fall between those two blue lines. So the question is, do you fall between those two blue lines and you're receiving the average earnings credit rate that other higher ed institutions are getting? Now, obviously, you want a higher earnings credit rate. So if you're not at least at that red line for your balance level, you may have some work to do, or you may have a telephone call to make. If we look at the $10 million balance level, first of all, let me point out that the market average, beyond higher ed, is 43 basis points. The market median, is 43 basis points. Here on this chart, you can see the red line at the $10 million mark intersects at 50 basis points. So higher ed is getting a higher median earnings credit rate than the rest of the market, which again is a very good thing. This is good news, again, and I won't restate all the reasons why this is good news. The band between the two blue lines are much tighter than we see in other industries as well. So it might say that higher ed is getting a slightly more favorable rate, but there's less latitude for negotiation. That range is 30 basis points on the low side to 61 basis points on the high side. So that's the good news on the earnings credit rate. You're getting your earnings credit rate that's a little bit better than the rest of the market. However, at 50 basis points, we hope you're not writing home about this or patting yourself on the back, because even though that is a good earnings credit rate, it is well below other rates that are available in the marketplace, and that's something that that you may need to take a look at. So on the next chart, we're going to talk about that a little bit. And this chart now, we're not talking about earnings credit rate, we're talking about the net effective rate. So as you recall, we said that the median earnings credit rate for higher ed was 50 basis points. Here, if we look at the blue line, the median net effective rate is 25 basis points. So that's only half of the earnings credit rate. That difference is the balance assessment fee that is assessed by banks against your accounts, and these assessments, are pass-throughs for FDIC insurance, as well as capital costs and liquidity costs and other regulatory recoupment activities that banks roll into that. So while you're getting a 50 basis point earnings credit rate, you're being assessed a 25 basis point recoupment fee, which is actually an above market assessment. So that works against you. So net at $10 million, you're earning, bottom line, 25 basis points. Had you in the second quarter invested that same $10 million in an institutional money market fund, you would have earned somewhere around 180 basis points. 25 versus 180. That is huge, and that is a real opportunity. That difference of 165 or 155 basis points, is $155,000 per year, bottom line, for every $10 million you have on deposit. So there are some real opportunity here. And again, these aren't theoretical numbers. These are actual numbers from actual Treasury Strategies clients using our NDepth tool. So with that as sort of the headline items here, there's a lot of good news and there's some bad news. There are a few things that we think the industry needs to investigate. And by the way, we'd like to help you do that. But let me pass this back to Kathy to talk about some very specific use cases around this information.
Great, thanks, Tony. So we want to show you how NDepth can point you to strategic questions you should be asking and give you ideas for saving time and money. All right, so one of the first things that NDepth does, or that you could do if you were trying to get some more value out of your account analyses, is to standardize and aggregate the data. NDepth does it automatically. So it takes all of what Tony called those pesky line items. It aggregates them into product families. We can display the aggregate value of a relationship in a dashboard report like the one you're seeing here. putting things into a standardized aggregated format month after month after month, our users say this is one of the most valuable things for them, one of the most difficult things for them to do manually. They look at a report like this and like it because it does that, but also because they can imagine themselves showing this to their management. They've got the complete snapshot of all of their banks. If this is my company that I'm managing with these 5 banks, I've got a picture for the month of the balances we're leaving there, the earnings we're getting from them, the services spend, and my net bill excess or deficit. We're also able to see how we're allocating our credit wallet, our services spend, and our collected balance bank by bank to see if those are arrayed in the way we want them across the banks that are most important to us. Another example of saving time is you don't have to spend any time entering data, formatting reports and graphs and charts to get beautiful dashboard reports like this. So we've picked out a few key metrics that we track over time in a time series report like this. Again, a really useful type of management report that lets you look at the time series of your services spend, of your balances, and of how the banks are moving their ECRs around. So you'd want to see these things acting in a way that you expect. So when it comes tuition time in the fall and spring, you're going to probably see your service charges peaking a little bit as your volumes of payment transactions rise. And your balances might also move with that. Maybe they're higher after you've got your tuition in and then they gradually drop down. If you don't see those kind of patterns, maybe something to explore. And on your ECR report, you don't want to see those lines flat, horizontal. You want to see them moving up over time. This poor company looks like its banks are doing something quite opposite of that. They kind of moved up, but now they're trending down. Wow, something to explore there. Anyway, great management kinds of tools that are produced with very little effort. Another area, now getting down into the more detail on the services spend, is all those pesky line items being aggregated into product families that make sense for you so you can compare bank to bank easily. Now, Tony introduced that concept of product families. We have defined in NDepth 9 standard product families and mapped every one of the 2,600 plus individual bank service charge items into those 9 product families. We've built that into the artificial intelligence and machine learning that's employed in NDepth so that when your account analyses, either your electronic PDFs or your 822s, either one, come into NDepth, they are automatically read and ingested and applied into the relevant product families. So automatically, these kind of reports that show you bank by bank how you're allocating your spend can be produced. And we've got the pie chart visual version and we've got the tabular version as well. So again, if I'm managing this company, I'm focused on pink, yellow, and green, which are my biggest spend areas. If you look at that chart down at the bottom, you're going to see that the funds transfer is my biggest spend area. More than half of my monthly spend goes for wires. And then my next 2 biggest areas are electronic payments, so ACHs, and Lockbox. So as the Treasury Manager, if I'm focused on managing my spend in those 3 areas, I'm managing my spend. Another way that NDepth helps you save not necessarily time, but money is when you can actually compare apples to apples pricing across your banks. This is sort of the mother lode of account analysis review. Now, we're not talking about doing this so you can find nickels and dimes lying around on the sidewalk. We're talking about doing this so that you can think strategically about ways to improve your spend, your allocation of services, the package of services that you're buying, and make some real strategic improvements in those areas for your company. In this example we have here, we first of all created the all-in or effective unit price. That's very important. It's one of the foundational concepts in addition to product families. So imagine we've got all the line items mapped into 9 product families. Then we figure out what the appropriate volume counters are for each of those product families, divide the total spend for the product family by the volume, and we get the effective all-in unit price. That is where you can start doing good comparisons bank to bank. And in this example here, I've circled the comparative prices for wire transfer at the 4 banks where I do wires. And my spend ranges from, my average price ranges from about $13 a wire up to $21 a wire. That's a pretty big range. And I've got some very healthy wire volumes going here. A couple of my banks, I'm well over 1,000 wires per month. So I might start thinking to myself, again, I'm thinking a little strategically here, do I need 4 wire banks? Could I possibly consolidate some of that volume into a bank that's going to give me better pricing? Or could I do some negotiating or something like that? But wait, before I actually dive into that, I think I want to know, how do these prices, these all-in prices, stack up against the benchmarks and the market pricing? So look down in the bottom right-hand corner where we've got the wire transfer price curves. These are identical in concept to the ones that Tony showed you a few minutes ago for Lockbox and not funds transfer, ACH. And the gold stars are my 4 wire transfer banks plotted on the benchmark curves. Now, none of my banks is got a price for me that's below the 25th percentile. In fact, they're all above or slightly above the 75th percentile. But the ones that are most troubling are the 2 on the far right, which happen to be my highest volume banks as well. So they are way off the benchmark. And thinking strategically, I have to first ask myself, is there something in terms of what I'm buying that's causing those prices to be so high?
Like telephone confirmations.
Yeah, or repairs, or manual entry, or maybe I'm not using repetitive templates. Maybe everything is a freeform wire and the prices are higher. There could be some things that we are doing inside the company that represent opportunities to get a lower price. Or maybe not. Maybe these 2 banks simply have prices for us that are a little bit off the market. So I'm going to ask myself, should I be negotiating? Can I move that business? I need to talk to these banks about what's going on. Maybe I should think about switching to ACH because my ACH prices are probably about 30 or 40 cents an item. Maybe that's a good opportunity for me. At any rate, NDepth has shown a bright light on this particular area that gives me opportunities for real strategic improvements. Another area, strategic improvement, looking at the variance reports every month. Lots of us, I think we look at the account analyses reports and we like to say, well, if everything is about the same as it was last month, then things are probably pretty okay. Here's a drill down to help you know if things were about the same as they were last month. This variance report shows you variances in volume, in unit price, and in total spend for all of your line items on your account analyses month to month. So I'm comparing this month to last month. And highlights any variance that's bigger than a pre-established percentage. So all you technically have to do is look for any box that's green or red and take a look at that and see if it's meaningful to you. I've highlighted one down on the bottom here that does seem meaningful. The outbound wires for our sample company here. Last month in May, we had 232 outbound wires. And then in June, I had 521. So that's an increase of 300 or so wires. What the heck? How do you generate 300 more wires in one month versus another? If I can't answer that question immediately by saying, well, I know there was, special payments to all of our service reps, bonus payments last month, and that accounts for it. If I can't come up with some kind of reason like that, then this is probably something I really need to dive into and find out what was going on. And by the way, it cost us $6,000 extra in June for all these extra wires. So it's not a small amount of money. And I think it again, NDepth is going to highlight things that are worth your time, not worth your time, but significant and strategic. And finally, a tool to help you focus on where you need to review your earnings credits. Tony gave you pretty much chapter and verse on this one already. Here are the 5 stars plotted on the ECR price curve for my 5 banks. And look at that one little lonely star down there at the bottom that represents Tri-Central Bank, where my calculated ECR is 0.05%. How paltry, right? So maybe I should just get these balances out of here. And by the way, this is one of my big balance banks. With these guys, I think I need to do something. I either need to negotiate something better with them, get those balances out of there and put them in a money market fund. If I'm a borrower, maybe I could pay down some short-term debt, really save some money. But this looks kind of sad, and NDepth has pointed that out to us. So just to wrap up this section, I want to share some testimonials from 2 of our users in the higher ed sector. Kathleen Morrissey at Brown University. The first thing that comes to her mind is how easy it is to use. And what she says is completely true. Just a few minutes to drag and drop your files into the portal and everything else is done for you. Honestly, you don't break a sweat. You spend all your time analyzing, looking at the data, as opposed to messing with getting the data into a usable form. Kathleen also said it's great to use this kind of data at bank discussions, and she feels better having good information at her fingertips. She has saved money from using it, which is no surprise to us. And she likes the reports. They're good for management reports, which is a plus for lots of us. Doug Stanford at DePaul mentions that it's the benchmarking that is his #1 item. He can't get this benchmarking anywhere else, and that's really helpful for him. He can quickly focus on trouble areas that need investigation. And he has confidence that finally, even without spending a ton of time, they're doing the fiduciary examination of these analyses that he has known all along that they need to be. That could be you. And we want to tell you how it could be you.
So, carpe diem. Let's seize the day. Let's get these kind of insights delivered to us monthly, and put these savings right into your bottom line. We have a special offer for you for all of the higher ed institutions, or all the educational institutions on this call. We have a 6-month free trial offer. We are so certain that you're going to love this and get value out of this that we want to put this power in depth at your fingertips. And we structure this so that we can easily make this happen for you. If you sign up by September 15th for up to 5 of your U.S. banks at the summary analysis level, now we know some of you may need to do this at an account level on an ongoing basis, but for the purpose of a trial, we keep this at a summary level. We will provide 6 months of the in-depth service for you for absolutely free. No obligation. At the end of 6 months, we don't charge your credit card or anything like that until you cancel whatever. Absolutely no risk to you, just the benefits. And what makes this especially attractive is it's very easy to set up and start using. As Kathy mentioned, simply drag and drop into the portal. Just a short phone call with our service team or Jill Salgrad herself can get you set up here. NDepth uses PDF files or EDI files. Unlike some other systems that are very complex, we're using state-of-the-art technology to be able to read these, map these, put these in place, and generate these reports for you. To set up, simply call Jill. Jill's standing by at her telephone right now, as a matter of fact, or send Jill an email, and she will take you through a very simple process of getting set up here. So see for yourselves and start saving time and money right now.
So thank you for joining us this afternoon. I want to shout out to the bankers that are on the call just for a second. Bankers, we do have a lot of higher eds already using NDepth. They're getting a lot of value out of it. If it's something you think some of your other higher ed customers could use, please let them know about it or let us know about it. We think it can make your relationships more effective and stronger over time. And for all of you higher eds on the call, we really just want to have you be able to tap into the value of this, to start using your data as opposed to entering your data, to start making some strategic decisions with your data as opposed to worrying about getting it into a spreadsheet. So we look forward to hearing from you and having you join us for our free 6-month trial as NDepth users. Thank you again for joining.